Be patient.
Well, good afternoon, investors. Welcome to our mid-July 2025 bull sessions. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and I'm joined by my dear colleague to a little bit to the north, the magnificent mathematician of mid-Michigan, Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark. How are you doing?
I'm doing very well. It was an interesting weekend, and we'll leave it at that for now. And looking forward to being standing in the spot where I took this picture here in a couple of weeks. And we'll go right by your house, Ken. You could jump in and stow away and come along with us up into the northern Michigan area. And some of you will actually recognize this picture. I took this one myself. It's not stolen from anybody else. This is straight off my camera. That is Burt Lake, Michigan. And by the way, fun fact, I think we may have talked about this a few weeks ago. That is the optimum location to be if nuclear war breaks out. That part of Michigan.
Is that?
Because it's the most strategically located compared to other targets.
Or unstrategically located, right?
Right. Strategically to be missed by any of the
I'm currently unlucky because between Evansville, Indiana and Fort Lauderdale, neither one are good to be at.
And that voice you're hearing is Kim Butcher. She mentioned Evansville and Florida. Good afternoon, Kim.
Hi, guys. Hope everyone's doing well.
And Matt, unfortunately, I think Houston is probably pretty high on a target list if they start flying. So
yeah, even in the movies, if you go back to Independence Day, even in the movies, Houston gets hit. So we'll just party like it's 1999.
There's a lot of important stuff down there, including you. So we're grateful for that. You and Ann Manning, even though she's picking on me this afternoon, we will take that. All right. So we're going to talk a little bit about roaring technology, and I've been hearing a whole bunch of people. I've actually watched a little bit of CNBC over the last few days, and they're still trying to back us into a recession, Ken.
Mark, I went back to CNBC and did some searching. I did this 3 or 4 days ago to answer a question online because I had mentioned about the recession that has been predicted for such a long time that you can't even remember when it started. The last time I could hear somebody talking about an imminent recession was about 14 months ago. So we've been doing it now for over a year. We've been claiming that it's going to happen any moment now. It was supposed to happen in the third quarter of last year. And it's just kind of been moved forward and forward and forward. And some of these people are going to be right. Isn't that true?
At some point, you're going to be right.
Yeah.
It's not taking shape, at least not yet. So
something about a blind squirrel or a broken clock, right? They're right occasionally. So
absolutely. So let's go ahead and press on. This is our disclaimer. Please do your own homework before making any decision. We'll talk about real companies in real time. No investment recommendation whatsoever is intended here. This is to demonstrate the philosophies, methods, and techniques of the modern investment club movement as practiced by the wonderful members of our community, many of whom are with us this afternoon. We're grateful you're here. You are your own boss. Make your own decisions. If you'd like copies of the slides, or if you have follow-up questions or suggestions for topics, please send an email to either of the two addresses on the screen. Emails.
27 seconds, Mark. 27 seconds. You're
better?
Doing better.
Okay, we'll try to
keep on moving.
We'll try to keep this one quick. On the right, Portillo's is still a hot mess when it comes to the stock price, as you can see. Kind of stuck in it. Well, maybe you can't see with all the ketchup and blood flying around there and relish. But it's hanging in that $12 range. But for those of you that did not know this, and in fact, Ann and Matt, you live close to a Portillo's now, you get a hot dog for $1 with your next $5 purchase this week. It is National Hot Dog Week. So that alone is worth the price of admission here, Ann, and maybe that'll take some of the pain out of your Deckers stock price. All right, moving on, because we don't know what to do with that graphic anyhow yet. All right, some of the stuff that's going on right now, we are basically starting a new year of bull sessions. We are going to take a couple weeks off for a summer break, and I'm going to go and wear out another pair of tennis shoes and hopefully win another tennis tournament. And just to head you guys all off at the pass, yes, it's again, the tournament will be against small children and ladies.
And maybe even a dog, you know.
But when you're looking to measure out performance, it's important to know what your benchmark is.
That's right. That's right. You know, just take home the gold. That's all that matters. But that is a picture of South Haven on the right, South Haven, Michigan, another wonderful place in the state of Michigan. But this week's updates are full of stuff from issue 11 of the Value Line Investment Survey, and there's a whole bunch of companies. So you might want to dust off your weekly things and take a look. We'll take a look at Target a little bit later on. But we will be back on August 5th, and there is a bull session, or excuse me, a roundtable. I believe is it the 28th, Ken?
It's the 29th, Mark.
29th, July 29th.
Yep.
So apparently I'll be there waiting the night 24 hours early. No, just kidding. All right, so here, just looking back, and I don't want to spend a lot of time with this, but we did start this 5 years ago. And I think we were fortunate to pull George Gilder's book off the shelf, and we all read it and had a lot of fun with it for a few weeks. And it actually launched a bunch of different things, including bottle rockets and S-curves and a different way of looking at big data, blockchain. We were talking about data centers years before everybody's been talking about data centers. So I just thought that was a nice one to capture. Even though, and yes, Kelly Buchanan, none of those animals up at the top are bulls. We get that now. Your thoughts, Ken?
I think one of the most relatable things that we got out of that book, Mark, was that the choke point, the bottleneck in the whole process of moving forward with technology was not going to be where a lot of people thought it was, but it was going to basically be electricity. And that was an interesting, brand new idea to me, at least, when we started this thing 5 years ago, that we didn't have unlimited generating power. And in fact, that the grid was becoming a little bit shaky even back in 2020. So first of all, I'm happy to have read the book and to have decided that I was going to look at things like graphene and nuclear power and helium and hydrogen power. And at the same time, I think that getting back and reading some serious literature occasionally has kept my mind from degenerating into a tossed salad. So I'm pleased about that as well.
Yeah, in the book, Mr. Gilder is pretty critical of the Google business model, but that has at least persisted until now. And there may be some challenges to it as we speak, but it's been an interesting ride. Yeah, I agree on the electricity. In fact, it's interesting that there's quite an incentive to charge your car here in Michigan at night versus during the day already. So we're on the edge of that already. And then here's 4 other covers or moments from those early years that I just thought were kind of fun. Our friends don't let friends be average investors is not new. That was the first time I can remember us talking about it that way. Right around the time we visited Donnelly's Irish Pub in Peoria, Illinois, Ken.
Yes, you're right.
And some pretty good stuff on there. Our 10th anniversary of the Roundtable was an excellent session. Down on the lower left, the 20 questions with the club out of Ann Arbor. I think we need to do that again. We have quite a demand for that, and we will certainly try to squeeze in a couple of those presentations, perhaps prep for the Chicago National Convention next year with something along those lines.
You know, Mark, I think it also might be a wise thing for us to maybe do some formal correspondence with a couple of the model clubs that are represented in this bull session on a regular basis. I mean, I know there's folks from the Houston Model Club here. There's folks from all of the model clubs that are active in mid-Michigan. We have folks from the Model Club in Illinois. We have them from the Rocky Mountain chapter, and maybe solicit some outstanding questions that they might have to go along with this 20 questions from that Ann Arbor club.
Absolutely. And people like Betsy out there continuing to push us down the small company path. I mean, there's examples everywhere. And then, of course, speaking of national conventions, this is after Ken and I left the convention in Dallas 4 or 5 years ago. Well, maybe 3 years ago. I don't know. 2 years ago. And that's our stop at Buc-ee's.
Because I had never experienced that a place like that. I was quiet and open-mouthed at seeing the number of gas pumps that existed at that Buc-ee's. So
it is a phenomenon to see, that's for sure. And they're propping up in more places all the time now. So there you go. And of course, that session also included that tantalizing discussion of breaking General Electric into pieces. And that's something we've promised to actually go back and give an update on.
I was also intrigued by the southern habit they told me of, since you have so many gas pumps, just leaving your car parked at the pump after you filled up to go into Buc-ee's and do whatever you wanted to do inside Buc-ee's. But so many of the pumps had cars parked in front of them, just parked there. Yeah.
I mean, you can get threatened or beat up or perhaps even shot for doing that in this area. So it's a whole different ball game. But again, just some interesting themes over the years, and we hope to continue. As long as you guys keep showing up and have questions and things to talk about, we will try to do that. Here's one contributed by Sean Mace. This is probably hot on Reddit right now. The Buffett indicator just went to an all-time high. And that's just, the Oracle of Omaha thinking that stocks may be a little bit pricey at the moment. You can see the definition there on the right. It's literally the total value of all stocks divided by the gross domestic product. Anything over 200, he thinks, is playing with fire. Probably explains why they have so many billions in the bank right now. And I just get a kick out of when people misspell something on an important graphic.
And this just in
wonderful to know what's on his pounds list.
This just in from Anita in our audience, Mark. There are 2 locations in Southern California. I don't know if she's speaking about Buc-ee's or if she's talking about Portillo's, but either way, she says wrong. There's 2 locations in Southern California. Who knew?
That's got to be Portillo's, I think. I don't think Buc-ee's has made it out there yet.
Well, she's going to clarify that, I'm sure, in the next couple of minutes for us. Yeah.
And of course, Hulbert says that going back, he's right. But my comment to this is we invest in companies, not markets. And that's always a good thing to remind ourselves. And we have the opportunity to invest in things like Deckers and watch them go down while the market goes up. Yeah, there's a difference between investing in companies and investing in markets, for sure. All right, here's a look at the stock market. The 3 to 5 year price appreciation potential for the Value Line universe. That's dictated by the Value Line arithmetic average. That's basically the average of all the companies in the Value Line investment survey, is actually down to 40%. It's only been lower than that a couple of times in the last 20 or 30 or even 40 years. And that is a new low. It's approaching. It's laying right on top of my par, by the way. And we just get a look. The market has continued up from where it was 6 months ago. And what are your thoughts, sir?
Well, I'm glad to see MyPar and Value Line tracking each other down to the 10th of a decimal there, but that's a pretty low return for the market. So it's sub-average return, and I don't know I don't have much to say about it, Mark, except that they are tracking now, and that's heartening. At least we know that the 2 data sources seem to be in agreement with each other.
Yeah, and rhyming with the Buffett indicator, it would just simply say that when you study stocks, it's harder to find a bargain. It's harder to find a really, really attractive stock. And
reporting.
Go ahead.
Reporting in real time, Anita has told us that they are Portillo's locations, and they're in, I hate to say the names of cities far away because I usually am not pronouncing it the way the people in the city pronounce it, but I'm going to pronounce it Buena Park and Moreno Valley. That's where the two Portillos are in California, Southern California.
And you got both of those correct. One of those is pretty close to Anaheim, I think. Buena Park. Yeah, we used to live out in that area, so you did fine, Ken.
Okay.
Good stuff. All right, Ken, this was prompted by your comment about Stephanie's comment. And for me, it's an AI demonstration. I just went to Perplexity and said, what did Stephanie Link say about, and what did you call it? Bad mouthing. Somebody was bad mouthing.
Yeah,
that's all I asked. I asked Perplexity and got this. So.
Yeah, the negative press surrounding certain tech stocks and the technology sector in general. And then she went on to elucidate about just people that end up, I think she talked about, oh, there it is right there in the quote, about being all on the same side of the boat.
Yeah, and when you've got convictions and you've got a basis for what you believe, doesn't mean you're going to be right, but at least you've got a basis. It can be outsized opportunity for sure. So
it comes back to that comment that we've used in teaching over the years, Mark, about the mattress company, when we wanted to decide whether what was happening to the mattress company was something that was temporary or terminal.
Exactly.
Same kind of idea. Yeah.
And unfortunately, I didn't buy that idea. It's another on one of those coulda, shoulda, woulda pile. More on that here in a minute. All right, and here is when Stephanie's right, she's really right. What you're looking at, and Ken and I are both sensitive to the fact that this is a little bit confusing, but the black is the S&P 500 over the last year or so, and you can see that from those post-tariff day plummets, it's actually recovered and it's back up here at all-time highs. And what the author of this article had basically done, it's from The Compound with Josh Brown. They basically had broken down that advance in the S&P 500 into its segments, and they've normalized it so we can look at which sector is contributing the most. And of course, here is Stephanie Link's pick from back in that time frame. And technology is carrying quite a heavy load again with the S&P 500. Does that clear it up for you a little bit?
Well, it's been clear to me since I looked at it in the beginning, Mark, but I think to clear it up for our viewers, our listeners, I think that what the chart is telling us is that communication service, industrials, and discretionary are basically doing as well as the S&P 500. Tech's doing a heck of a lot better, and staples and healthcare are doing a heck of a lot worse. And it's just relative performance compared to the S&P, and that scale off to the side, a 100 would mean that the sector is doing exactly as well as the S&P is doing.
Absolutely, and I would just caution everybody, we're only talking about 3 months here. 3 very momentous, eventful months, but only 3 months.
This is the first time, Mark, that I've seen data like this displayed in this manner. And once you get used to what you're looking at, I think this might be a nice thing to look at long term as well. Again, my instincts say that long term, those lines for a lot of the sectors are going to move to that 100% mark.
Yep.
But short term, that's the opportunity that's built into any market, because like it or not, the market is not going to be rational in a lot of ways over short periods of time.
Well, I'm sure that Len Douglas could do this in his sleep, and he probably just took that as a personal challenge, Ken. So we'll see. We'll see what Len comes up with. All right, let's talk a little bit about the recession. Again, we think of a recession as generally fostering opportunity, or basically the weaker companies are exposed during a recession. So what you're looking at here is a 15-year look at operating margin and net margin. That would be earnings per share, net margin. And you can see the COVID disruption. And again, anytime that there is a recession, you basically get a dip in that longer term trend. And it's not looking very dippy, at least not yet for 25 or 26. So, there's a lot of strength, underlying strength in the overall market right now. Any thoughts on this, Ken?
I think it's self-explanatory. You did a good job, Mark. Yeah.
All right. Here is another thing that we look at for markets falling apart, and it just occurred to me probably during one of my longer drives. We've talked about various ways to look at this, and it is a way to gauge sentiment and the market's overall behavior. It's a breadth indicator if you want to look into that, but it's the number of U.S. new highs minus the number of new lows. So if more stocks are making new lows, it'll drive the charted area down that you see here as designated by these green, and I guess they're magenta or maroon shaded areas. And then just to take some of the noise out of it, all we're doing is looking at a 12-month moving average with the blue line. That's what I really look at. Okay, so that's showing the moving average over time of the amount of new stocks hitting new highs versus new lows. You asked in the past, it's not the S&P 500. This is actually all stocks traded on the New York Stock Exchange. This is the way that I understand it, Ken. So you're looking at some interesting periods over time. You can see the financial crisis of 2008, 2009. You can see the COVID spike over here. But the way I would look at this, again, just looking for some indication of sentiment. Anytime this blue line is actually sloping downward, it's like having your foot on the brake with respect to the market. And ultimately, the market follows and goes down, at least on the chart. Anytime that line is sloping up, think of it as pressing on the accelerator. And no, there's no connotation of this guy being British or anything like that, even though he's on the wrong side of the car. But so anytime you've got that upper sloping exponential moving average, that's a good thing for the market, and you basically see this type of a pattern. Okay, so during COVID, we had not just breaks, but we hit a brick wall. Look how steep this drop was right here. And it took a lot, it basically caused a lot of carnage along with it. So that's hitting the brick wall. So where are we today? I would say gentle accelerator. So again, that is the opposite of the recessionary stuff that they're talking about. Your thoughts?
Well, Mark, is this kind of a chicken egg kind of an argument as well, that the new lows come from the market moving lower, and the market moves lower because there's a lot of more new lows? Is it kind of a circular thing?
The point that's been made by the people who propagate this chart, let's take this one for example. All of this tops out. You see how all of this is topping out well before the market starts on its downward descent. So it's in their opinion, it's one of the better leading indicators of either bullish or bearish times ahead. And you can even go back to 2008. I mean, the market finally began its descent, after the start of 2008. You could technically say Halloween 2007, but this was falling off well before that actually began to materialize, certainly by mid 2008 or second quarter 2008. So again, this is just the people who do this sort of thing. I just look at it for if you're a person in capital preservation mode, perhaps a more experienced or elderly person protecting assets, this would be something I would look at. I have used this in the past to discourage people from running for the hills. And this would be one of the times I would say, I don't think you need to run for the hills based on what you see on the right-hand side of this chart. Not that we ever run for the hills, but in some cases it is prudent for people to go into protective mode. Okay. So I just thought that those images maybe explain a little bit better than we have in the past about what people are actually, what they think they see with this chart. All right. And then, of course, there's this one that we've talked about for several months. I did leave Cannonball Man off of this, Ken. You're welcome. But I did stick the COVID thing on there because you can see what happened to the cash flow for the average company back with COVID. And then we have talked many times about how 2003 was not as strong as people thought it was, and neither was 2004, economically speaking, macro. Cash flow was actually down for the average company in that time frame. And again, the question being, all these people that are worried on CNBC, if that's anywhere near correct for the end of 2025, I don't know. I don't think I would be gravely concerned looking at that picture, assuming that the forecasts are any good at all.
Well, and I know immediately, Mark, what the folks that are gravely concerned would say. Everything's fine until it's not. That's the kind of argument that's always used when somebody that's relatively optimistic is talking about the stock market. You have a whole lot of folks that make their money by being pessimists, especially in the professional ranks. And they've, like I said earlier, they've been pessimistic now for more, at least 14 months, maybe longer than that, that everything's going to go to heck in a handbasket. And so far, nobody's been correct about calling that recession, but like I indicated earlier, somebody's going to be right one of these days, and then it'll happen.
And you make me wish I'd put our blue and red slide in here again that shows how limited the damage, even with the terrible market of 2008, 2009, and COVID. The recoveries were actually pretty quick. You know, for anybody who remained invested and bought into some of these opportunities back in this time frame, and trust me, I know how hard it was. I remember those days. But if you invested regularly through that, you were back to even at least by here. So even in the worst financial crisis.
I heard our friend Mr. Brown on CNBC, Josh Brown, indicate that one of the hardest things is getting out of the market when you're afraid, and one of the more harder things is figuring out when to get back in. So,
absolutely. Yeah, he was talking recently about a friend that exited the market in 2014 and still hadn't recommitted funds. You know, yeah. Ow. Ouch. And if Josh Brown can't convince you, I think you need therapy or something. All right. Here's just a reminder that we do actually post the earnings at the bottom of our weekly updates, and there is quite a bit of stuff going on. JP Morgan had a very positive report this morning after the market opened, I believe, or just before the market opened, and inflation came out. We'll talk about that in a minute, an inflation reading. And Carol from the DC Metro chapter sent me that image of the puppy and the cup of coffee. And it rhymes with a song that many of us love. So here is the JP Morgan. There's a bunch of stuff going on. It is the beginning of earnings season. So that's the reason I put this here. So it can be, I actually do not pay that much attention to quarterly stuff, but it is kind of fun to watch these guys stumble into the confessional every 3 months. Any other comments, Ken?
No, my screen is suddenly giant, so I'm sitting here trying to figure out how to bring my screen back to regular. I don't know what happened, but I hope it's only my screen. So.
Did you zoom in on the puppy? I can check that.
I might have, but I can't zoom the other way, so I'll figure it out here. at some point.
The
Okay.
audience view appears to be normal, so we'll hope that you recover here pretty
I
soon.
would add, Mark, for bank reporting, Western Alliance is reporting Wednesday. And
We'll
I'll
put that one
say,
in there.
yeah, it certainly has done quite well for those who bought in the depths of 2023. I'm not really happy. Its return on average assets has been 1.02% now for 2 years straight.
Oh,
So I'm kind of getting antsy about it. So I am watching that quarter by quarter. It's much safer. They've worked on all their safety metrics, particularly their CET1 ratio is one of the key ones everyone looks at. But their profitability needs to get some oomph into it one way or another.
what do you think's holding them back? Any thoughts? I mean, are they?
Well, they said even back by May of 2023, they said they were not going to focus on growing as fast as they used to. They said they didn't think that their stock ever was rewarded because of that. Their PE didn't match it.
Okay.
They're definitely going to be more cautious, but I've not heard any specific thing like they're pulling out of a particular line of business or switching that. I think it has been building capital. So I wouldn't have been surprised if it was that for a year. But as the now they aren't subject to the same Fed stress test the big banks are, but those just came out. So the big banks are also deploying capital now because they passed quite well. So stock buybacks, dividend increases, maybe some M&A. I hope that sort of trickles down to the industry too, and people get more comfortable with, let's say, business as normal or business as before. But
Yeah,
it's something I am watching.
that could provide some support in the southwestern economy also, which wouldn't hurt Western Alliance at all.
Yep.
So yeah, and Kevin Galuglia, I still own my Western Alliance, purchased on that day quite some time ago, and it's in the Buttonwood portfolio too. So I own it twice, Kevin. So there. Just a quick look at inflation. That also came out this morning. Not something we obsess over. Brian Westbury makes his usual point that it doesn't really have anything to do with tariffs, but nobody knows that. And he's a respected economist, and he really sticks to this notion of following the M2 money supply. That's what really matters. It actually came in at 0.2, so it came in a little bit below expectations. And he says if you calculate it right, it's not nearly as bad as people are writing.
I think the most powerful thing that he says, Mark, is better to look at a 3-month annualized change rather than a 1-month number. I would prefer that he say better to look at a 6-month or 1-year annualized change rather than a 1-month number. As an investor, I don't think a 1-month number is telling me very much at all. And as watching the economy, I'm not sure that a 1-month number is telling me enough to really make any conclusion.
Yeah, I can remember a presentation by Ralph from Acorn, the Acorn Fund years ago, Ralph Wanger, where he went back and showed revisions to the numbers that you see on the screen and how much they change. So you pay all that attention on Tuesday morning, this morning, and 3 months from now, the numbers will be different. So the revisions are persistent, and in some cases quite large. So I
talked about that in Keeping Score, one of the psychology of investing presentations I did in Last Bank. And if you recall the statistical analysis that came out of Fooled by Randomness, if you're looking at daily price moves, and it's nothing special about the market, it's the idea of looking at narrow frames versus big frames. You are looking at you're 10 times as likely to be reacting to noise as signal.
Yep.
And that goes for any statistical data, but any sort of time series.
And that's why it's good when we pay more attention to 5-year horizons than 1-month horizons or anything like that.
Yeah, even annual, the ratio of noise to signal is still 0.7 to 1. It's only a 60-40 chance that an annual rate is actual change in real underlying conditions.
Absolutely. So that's why, you know, for example, on this chart, we try to use a 10-year trailing horizon. So 10 years, these are 10 years of data, and much of the noise will have been subdued. Of course, it does bother me a little bit, but I'm trying to ignore it, Ken, that one at the bottom is at 0.
Well, it's better than being red, Mark. Okay.
But, you know, other things that are on here that we've talked about in the past, not going to beat them up right now, but it's normal for the S&P or for the value line arithmetic average to be up here. So at some point, that's going to have to revert to the long-term trend. And of course, the NASDAQ, with the technology stocks continuing so strong, this is really chunking away pretty good too. I will draw your attention, Ken, to the fact that we have snuck above 3 for the roundtable again on the relative
Great.
return. That's the amount of outperformance if you're new
Yep,
to that metric.
Let's move that baby up to 5 again if we can, you know?
All right, so setting up for the groundhog, you're going to see that a few people have made some major moves. I believe this is from today's Wall Street Journal, MP Materials, and you can see the price jump in MP Materials. That was one of our best small companies from 2 years ago, and I wish I could say I still owned it, but quite a good run for MP Materials. And Matt pointed out that it's being tracked by some pretty interesting people down there at the bottom. All right, so here, and then this also came up. The Trade Desk took off. I had noticed this on the ticker yesterday. Trade Desk is up 10% yesterday, 8% today. They were added to the S&P 500 in a non-standard transaction or a special transaction when another company was removed. So I just asked the question of Grok, what other companies are candidates? Because for me, I think it could be a little bit of a tiebreaker. I'm on such a losing streak, Ann, that I'm desperate here. I need one of these, you know, I need to be interested in one of these and then get it before the S&P 500 bump actually helps with the purchase. So if you're tracking any one of those, that could be the tiebreaker between that and another company on a stock comparison guide. All right. Well, here's where I'll go silent. Go ahead, Ken.
Well, we have 12 clubs in the top 40 again, and we've had some tremendous moves, basically with some of these really hot small stocks that have been moving in high double digits over the last 3 or 4 weeks, and especially in the last week. Check out Bill Warner. He's moved up to 41st place, just one out of the top 40 now, but he moved from 167th. And our friend from the Rocky Mountain chapter, Betsy Wills, is now in the top 5. She was there last week, and she's moved up to 4. Mark's Snakebite continues to work for Norm Chemnitzer. Norm has moved from first to second and then down to 11th, moving the wrong way, Norm. But all in all, I like this 7.8% above the market for the average groundhog portfolio. That's a really nice place to be. 7.8% above what a very, very strong market is doing to these groundhog portfolios. So,
and for those of you that were with us in the pre-session, Kay Light has actually topped 40% today. She is currently in first place in the real-time standings, so we had some fun with that also. She does have that MP Materials as one of her stocks, and I think you would find MP or maybe a splash of Bitcoin related or nuclear. SMR or Nukes or Oklo is doing pretty well too, Ken.
Absolutely. And our best small company, Mark, in our list that we showed last week was Credo, CREDO. CRDO is the ticker. And Kay has that in her portfolio as well. So that's helping push her up. I'm riding Credo up into the top 20. So I'm very pleased with that.
All right, moving on. It is good to see the monkey dropping down the standings while everybody else is going up. Just a quick look at the Buttonwood portfolio. We are at 4,300, which is an all-time high on the balance, all-time high on the future value. So we want to keep that moving in the right direction. And we'll be watching this fairly closely here. We're not going to do anything with this other than to just notice that I think the moves we've made for the portfolio, I'm knocking on wood, other than Deckers going down after we bought it. So apparently 7% in the last week to make Ann Manning agitated. So that's probably the next on the curse list. But
Well, and for anybody new to looking at this, we're very aware of what's going on with United Health, with Gentex, and with Lululemon. We're very aware of that. And it's not that we're ignoring it and we're not turning our backs on it. We're not just whistling in the dark, but we have real reasons for keeping them in the portfolio at the present time.
and the reality, and I'm gonna snake bite myself here, Ken. If I go away and I pay less attention to this for 2 weeks, the probability that it'll go up actually increases, I think.
Well, good,
It was-
ignore
Make
it.
sure to have a hot dog when you're gone. That completes the story.
Just ignore it completely, okay?
swing by Portillo's. Yeah. All right. Moving on. Just a quick note, because people have been latching on to this concept and they're curious about it. I get that. I did want to make sure we're budgeting 0.25 25-cent dividend. These are weekly dividends for this Round Hill QQQ. It's basically based on the QQQ, the NASDAQ 100, and they're using that special options enhancement for enhanced yield. The yield could be anywhere from 20 to 40% per year per their advertising. And we're basically watching that. We're curious as to how much yield they will generate at the risk of perhaps knocking down their principal. So we want to understand that. It wouldn't bother me a whole lot, Ken, if we get a 20% yield and we get a little bit of a reduction in the principal that we could take for a capital loss or something at some point. But the whole goal here is to again, pay the electric bill and keep this column here above zero, out of the red ink. And with it's basically $200 per month from the Round Hill ETF, that's an exchange traded fund, and another 100 from JEPI. We're in pretty good shape.
Well, the thing we're going to watch real carefully, for those of you that watch the charts in a very concentrated way, is we don't care if that principal goes down like it did 7 cents in the last week. But we don't like the appreciation moving in the same direction. The whole theory of this is supposed to be, if the principal goes down, the appreciation moves up, and moves up quite smartly. So right now it's not performing the way we expect it to.
Nope, and we'll give it time because we're patient.
Absolutely.
We are so
Absolutely.
patient. We are Buttonwood patient. So there you go. All right, just a quick reminder, I'd actually received a couple notes, one from a lady who was absolutely stunned that we do this. This is from the homepage at Manifest Investing. If you click on any one of these, like Deckers, and if you want to see some of the slight reductions in expectations for Deckers with the current release from Value Line, you can actually click on it. You can click on any one of these, and these are active links to the Value Line close and the way that we look at companies, the equity analysis for any one of these companies, and just a reinforcement that we've been doing this for 5 years here. Got a whole bunch of positive comments from the bull. Maybe we keep this bull, Ken.
He's a good one, Mark. He's a real good one, yeah.
Ken
Happy
Andrews.
birthday, by the way. I didn't realize it was our birthday. I thought we were a little bit beyond that, but was it actually 5 years this week? Okay.
Well, it's kind of it took shape, plus or minus a week 5 years ago.
Okay, great.
So, there you have it. Here's a quick look at Target. I know this is in many portfolios of the community, and it's been a favorite. It is a roundtable selection, and you can see that this is a company with a projected return somewhere in the 10% range, which isn't all bad. The one thing that would give many of us pause is the lack of slope here. The long-term sales expectation is somewhere in low single digits. And that does cause a little bit of a pause for many of us. And it actually percolates down to the earnings. And the company right now Target does have a 10%-ish return forecast, and we're okay with that. I'm not extremely warm and fuzzy about this trend, Ken. That's not in the right direction with respect to quality.
Well, they're being compared against some pretty heavy hitters, Mark, and two of our four pillars of quality are comp kind of things against the industry. And when you're sitting in an industry with Walmarts and companies like that, Target might be taking a little bit of a hit with their quality.
Yep. And when you have a PE of 50 at Costco, that also is interesting. And then just wanted to point out, when we look a little bit deeper, when you look at the cash flow for the company, you find that 3 of the last 5 years, including the forecast year, are negative here. So again, that's a warning signal to us. We're looking at single-digit cash flow growth projected. Value line is still fairly decent on the return forecast, but you can see that the operating margin, that looks a little bit like Gentex to me, Ken. Just enough to have heartburn here. And then I would probably be looking for an opportunity to sell. If this were to go to a relative strength index of 80, I don't know if we do have relative strength on here. If this ever hit 80, I might be subjecting it to a selling analysis.
What I don't like ever to see a company, Mark, where the projected PE value, and use your numbers, folks, looks like it's going from a PE around 11, maybe even 10.5, up to a PE of around 15. That's a 35, 40, 45% jump in PE. And I don't like to project that much of a PE expansion for a company that's growing as slowly as this company is.
Yeah, if you're thinking trend, that might be more like the trend. So yeah, and that's a margin where the error could definitely creep in. All right, so with that, I suppose we can open up for questions. That's all I had for today. Here are our most recent roundtables and bull sessions. Looks like our artificial intelligence one had fallen off. You can actually find that St. Louis roundtable. That was April, if memory serves me correctly, Ken. We've had a couple of people ask us when we did that. April 2025.
More than a couple, Mark. I sent you that last one just to let you know that I'm answering. Still a lot of people want to know where they can find the presentation. I have my standard YouTube URL out there for them, and we're getting still a lot of comments about that presentation, which is another reason why I think we need to do something similar in the next 3 or 4 or 5 weeks. Yeah.
Okay, we'll definitely put together an artificial intelligence update in that spirit. All right, here's where I'm headed. It's one of the most beautiful lakes in the state of Michigan. That is what is now a 10-year-old grandson, back when he was probably 2 or 3, seated on the lower right. That's my wonderful spouse on the left. And she regularly beats me in tennis, by the way.
Diane is online in our audience, Mark, letting us know that NICE, which is one of our cash flow aristocrats, NICE was a featured pick by the Barron's Roundtable this week. So that's interesting to know, and you might want to check that out. I think you get Barron's, don't you?
I do. I will check that out. In fact, I had meant to check that out and just simply ran out of time.
Yeah, we're also getting comments from a couple of different folks. Halisi says targets where politics meets economics.
Yes.
And Aramita says that the effects of the Target boycott are beginning to take hold as far as she's concerned.
Yeah,
that's that's not a personal opinion. That's an opinion from Forbes
Right.
that she's relaying to us. Yeah.
I believe I saw that Forbes article, and it's kind of stunning that it has been that the effect has been that lasting. But it was pretty bad with Budweiser and Bud Light also. And again, I'm not taking a position, not expressing an opinion. I just know that, hey, I was pulled aside by the guy stocking shelves in the grocery store. He said, we have a serious problem here. He was from Budweiser. And he was right. And here is the newest member of our family, indirect family. Our daughter just picked up Leo. And Leo probably ends up at my house more often
Is that
than that.
Leo the Labradoodle? Is that a Labradoodle?
Yeah, he is a golden Labradoodle.
Okay, he's a cutie.
And he's adorable, but I suspect that I'll be able to claim him on my tax return before
Maybe.
all is said and done.
Maybe she just thought you needed a pup, Mark. That's all, you know.
Could be. All right, here's a reminder. We're going to take a couple weeks off while I go out and wear out some more shoes and win another tournament, maybe even a euchre tournament along the way. But we will be back on August 5th. And that will not interfere with the roundtable. We'll actually, in fact, Ken, if you want to come up, we'll do a simulcast from Burt Lake if you want.
Well, I'll tell you, Mark,
for the
we're going
roundtable.
to be down in Tennessee at that time, so we're moving in the opposite direction that you're moving. So
We've got this great nation covered. Then we'll
yep.
continue to enjoy that. And one of the things I thought we might do is take a quick look at where to find that, because we are getting a number of questions about that St. Louis presentation. If you're up for that, Ken.
Sure.
Let me go ahead and. That's what the real-time spreadsheet looks like for bull, or for the groundhog, by the way. Let me go ahead and all you need to do is go to youtube.com. This is running a little bit slower than usual, but I think this will be all right. Can you see that okay, Ken?
Absolutely.
Okay, so if you go to youtube.com and search for Manifest Investing or Bull Sessions or Roundtable, you will find this page. If you can't find it, send either Ken or me a note. And then if you click on videos, you'll actually get presented in chronological order going back. So the one that we're getting questions about, you'll see is just scrolled off the top 12. So it's here now. This roundtable from April 2025 was with the St. Louis chapter. The first hour is a session on introductory concepts and important things to think about for artificial intelligence, and focused pretty much on how it relates to investing, but crossover. And I apologized earlier for not showing Cannonball Man. There he is, Ken, right next to that April session. So again,
I'm also thinking, Mark, that the idea that comes from our friend in Maryland, Kevin Galogli, about doing a separate session on growth and how the idea of growth permeates everything that we do within our investing philosophy. And maybe we can add that in front of a roundtable for one of the upcoming ones, a session with some of our friends from throughout the country talking about growth.
That's a great idea. I think we've talked about digging into the works of David L. Babson, T. Rowe Price, and a couple others from that time frame. And Craig Bramer has agreed to participate in that. I think the four of us could just have a blast exploring that topic.
Well, there's probably a couple of other folks we can add to that discussion as well. So
absolutely. So you can count on that for either late August or definitely September.
Yep.
And
Yep.
I think putting a special bull session in front of a round table, nighttime edition, could be a capital idea.
Yep. Agreed.
All right. Anything else in the hopper?
I've been keeping up with the questions pretty well. And I think we have everything answered to everybody's satisfaction. Most of the questions are actually comments, and I've relayed most of them to you and to the rest of the audience. So I'm just going to say good afternoon to everybody. Wish you a happy July, and I'm raring to go on vacation somewhere. We've been finishing. We got the stuff in the house finally finished, and I'm raring to get out of here.
And I will do my best to return here in one piece from the northern excursion, and it's always good to come back home in one piece. So with that, thank you all for being with us. Again, send us any comments or suggestions or requests for future topics. We love to hear from you, and thanks for being here. Take care, everybody.
Halisi is listening to us in Portugal, so he says good night. All right.
Excellent. We'll have to do a global pin map one of these days.
Good afternoon, all.
All right. Take care, everybody.
Everybody.